In my last videos, I brought up statistics on retracements back into the defining range. Today, we're diving a bit deeper into that topic and see what insights we can gather from historical data and how useful it can be for your trading. First of all, let me explain what exactly is being measured. With the DR trading strategy, we ideally wait for a close outside the defining range on a 5-minute time frame to confirm the direction we want to trade for the session. This already gives us a statistical edge, where we know that with a high percentage, which depends on the asset you trade, price will typically not close back through the opposite side of the defining range before the session ends. For optimal entries and exits, we measure retracement and extension levels in standard deviations. A Fibonacci retracement tool can be applied to the lowest and highest 5-minute close within the first hour of the defining range session. This provides retracement levels both inside and outside the defining range, as well as extension levels in the direction you want to trade. A retracement after confirmation doesn't always have to reach the defining range before extending higher to make the session high. This example would be classified as a positive retracement, where price retraces back to the plus 0.2 standard deviation before extending higher. This one would be classified as a retracement that didn't reach into the defining range. A retracement back to the plus 0.1 level is also considered a positive retracement. The difference here is that it reached into the defining range but not into the implied defining range. For the statistics, it would be counted as a retracement into the defining range. A retracement below the IDR high would be classified as a negative retracement and statistically counted as a retracement into the implied defining range. But the question is, what insights do you gain out of it? For today's example, we will look at the statistics for the light crude oil market during regular defining range sessions only, broken down by weekdays from Monday to Friday. We will start with retracements into the defining range and implied defining range following a long confirmation. For retracements back into the defining range after a long confirmation, it appears that Wednesdays have the least percentage with 80.2%. Thursdays and Fridays come close to 90%. For retracements back into the implied defining range, Friday holds the highest percentage with 75.5%. Mondays and Wednesdays fall slightly below 70%. Retracements following a short confirmation on the other side have relatively high percentages for every day, except for Wednesdays where it's slightly lower with 80.2%. Looking at the statistics for retracements back into the implied defining range, Thursdays and Fridays come close to 80%, followed by Tuesday at 75.4%. Mondays and Wednesdays also hold their ground at around 70%. When looking at all days, what insights do you get here? Crude oil futures has a high percentage to return back into the defining range after making a confirmation, except on Wednesdays, where it is slightly lower, sitting at 80.2%. For a retracement back into the implied defining range after a confirmation, not only Wednesday is lower with 70.3%, but also Monday with 69.3%. To visually demonstrate the insights, let's start with Monday. The percentage difference between a retracement into the defining range and one into the implied defining range is 14%. This lets us assume that after a confirmation happens, price tends to make a relatively shallow retracement before extending higher to form the high of the session compared to Tuesday, Thursday, and Friday. A sweet spot for your first entry on Monday's regular DR session can therefore be anywhere between the defining range high and the implied defining range high. For shorts, the opposite applies. Moving on to Wednesday, we see the lowest percentage of retracements back into the defining range compared to all other weekdays. The retracement into the implied defining range sits at 70.3%, also lower than the other weekdays. This suggests that after a confirmation, price often tends to make an extremely shallow retracement, one that doesn't even reach the defining range before extending higher to make the session high. Visually, this would look like a positive retracement into the plus 0.2 standard deviation level, followed by an extension to the upside. A sweet spot for your first entry on Wednesday's regular DR session can therefore be anywhere above the defining range high and up to the implied defining range high. To visualize it even more, let's have a look at historical data, filtering for the Wednesday's regular DR session example. We are looking at Wednesday's regular DR session data when a long confirmation happens between 10:30 and 11 a.m. For time and price trading, we will only focus on the time where historically 50% of retracements happened, which is from 10:30 to 11 a.m. In the retracement distribution, the Wednesday data we analyzed earlier supports this observation quite well. As you can see in the distribution curve, a decent bulk of retracements happened right before the zero retracement level, which would mark the beginning of the implied defining range. The positive values on the right could have either reached above the defining range or into the defining range, but not into the implied defining range. Our sweet spot for a first entry is therefore confirmed, since more than 50% of retracements happened above the implied defining range. I hope you've gained some new insights from this video. Data always tells a story, and the more you collect, the deeper your insights will be. This kind of data is easy to collect and anyone can do it. I'm sharing this information for free. It's up to you to use it. Have a great trading week, and I hope to see you in the next video. We're gonna take on the world.